Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I am going to walk you through the process of valuing SBUX stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. SBUX is a chain of coffee houses. Its headquarters are in Seattle, Washington. It is the world's largest coffee house chain. There are over 30,000 locations in 70 countries. They serve espresso, cafe latte, tea, juices, frappuccinos, pastries, chips, sandwiches, and much more. The company was founded in 1971. During the early 80s, the founders sold the company to Howard Schultz. The new owner had a business trip in Milan, Italy. After that trip, he decided to make the stores into coffee shops. He aggressively grew the business. The company has received significant criticism about its business practices and role in society. On the flip side, the company has created immense brand loyalty with its customers. Let's get started with the model. This is a large cap company, 114 billion market cap. They're trading at $97 a share, and they have 1.2 billion shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see the company does have positive free cash flow every year, but it's really small in 2020. Net income is the profit and loss on the income statement. It's revenue minus expenses. That's also low in 2020, much higher in prior years. Revenue is the sales for the company. That peaked in 2019, then dropped in 2020 due to COVID. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Then below that is the gross profit. So they had really low gross profit in 2020 because their cost of revenue was pretty similar to prior years, but they had much lower revenue. Then below that is operating expenses, which is pretty consistent each year. Then below that is operating income. That was high in 2018 and 19, but dropped a lot in 2020. They paid $426 million of interest on their debt. Then below that is other income and expenses, which are usually investments or impairments. Then below that is pre-tax income. Then their taxes. So they do have positive net income every year, but it was pretty small in 2020, much higher in 2018 and 19. The company is still profitable, but with coronavirus, they did struggle a little bit and had much lower net income. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. Then you have capital expenditures, which are investments in property, plant, and equipment. So you can see the company had very little free cash flow in 2020. They did have a lot in 2019 and a huge amount in 2018, almost 10 billion. The company bought back a lot of stock in 2018 and 2019, 7 billion and 10 billion. When a company buys back stock, it makes the remaining shares more valuable and inflates the stock price. The company also issues a lot of debt. They issued 6 billion in 2018, 2 billion in 2019, and 6 billion in 2020. The most important part of any business is their operating cash flow, and they generated a lot of operating cash flow in 2018, almost $12 billion. It dropped to 5 billion in 2019 and dropped again to 1.6 billion in 2020. The way you calculate operating cash flow, you start with net income. That was 660 million. Then you have to add back the depreciation because that's a non-cash item that gets passed through as an expense onto the income statement. Then they had 257 million of stock-based compensation and negative 2.5 billion in changes in working capital. So even though they reported 660 million of profit, they actually generated 1.6 billion of cash flow. Because you have to remember, net income is accounting profit and loss. It's not actual cash. Let's look at the capital structure. They have negative $8 billion of equity. That means their liabilities are $8 billion more than their assets, and they have $25 billion of debt. They have $20 billion of net debt. Net debt is debt minus cash. Their WACC is 7.3%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $107 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $94 billion. We divide that by 1.2 billion shares. And we get a calculated stock price of $80. They're trading at $97, so they're trading at a 22% premium. It's a sell according to the model. Simply Wall Street values a company at 104, so they're saying it's undervalued. They're saying it's a buy. The stock was about $60 in 2016, but the price was going up and up for about 4 straight years. Then coronavirus came and the stock crashed, but it came all the way back up past its all-time high. It came down a little bit, but this stock has done really well with coronavirus. I think investors feel this company is not going to be affected too much. It was affected a little bit, but not nearly as much as other companies. And this company raises its dividend each year. They pay a 1.7% dividend yield, and they pay out 300% of their net income. So that means they have to use debt to pay their dividend payment. And they have a low beta, 0.82, so the stock moves less than the market. It's not volatile. The stock has gone up 13% in the past 52 weeks, pretty close to the S&P 500, which went up 14%. The low was 50, the high was 108. And the stock is trading above its 200-day moving average, but below its 50-day moving average. 6.5 million to 8 million shares are traded each day for this stock, and all the shares outstanding are on float. 70% of the shares are held by institutions, and less than 1% of the shares are shorted. This stock has done well the past decade. If you invested $10,000 10 years ago, pretty much the longer you held the stock, the better off you would have been. Your $10,000 investment will be worth over $70,000 today. That's a great return on investment. That's a 22% annual return. Vanguard is the biggest shareholder at 7.6%, then BlackRock, then State Street, Magellan, and Northern Trust. Let's look at the financial ratios. The average PE in the market's 11.2, the median is 14.4. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have a really bad PE ratio, 171, so investors are paying $171 for $1 of earnings. Price to sales is stock price over sales per share. They're at 4.9, which is between the median and average. Price to book is stock price over book value per share. They're negative since they have negative book value. The way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities on the balance sheet, and they have negative $7.8 billion of equity, negative $12 billion of tangible equity, because they have $3.5 billion of goodwill and $500 million of other intangibles on their balance sheet. Interest coverage ratio is EBIT over interest expense. They're at 2.7, so they can almost cover their interest payments 3 times. ROE is net income over equity. They have negative equity, so they have negative ROE. Current ratio is current assets over current liabilities. They're at 1.1, so they have a good current ratio. And their current assets are $4.5 billion of cash, $1.5 billion of receivables, and $1.5 billion of inventory. So it does look like the company will need to take on more debt unless their free cash flow is a lot higher in 2021. They have only $500 million of working capital, a $2 billion dividend payment. So they'll be short about $1.3 billion. The best way to look at ratios to compare them to similar companies, I've done videos of 13 companies in the same industry as Starbucks. If Starbucks has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they're worse in all the price multiples. They do have a higher current ratio than average. The average is below 1 for this industry. They have a better ROE because they have negative equity, so we can't really look at the ROE. They're 100% debt. McDonald's is the biggest company, but Starbucks is the second biggest. They're both massive brands that are known all around the world. And they do pay a dividend. Most companies in this industry do not pay a dividend. So to summarize, I do have them trading at a 22% premium. The stock price is based off of investors' perception of the company's future. With that said, investors may feel the stock will go higher and it could push the price up to $200 a share. Fundamentals are important, but fundamentals are for a long-term investment. Anything can happen on a short-term basis. I rank their free cash flows 3 out of 10. They've really been dropping. 2019 free cash flow was only 1/3 of 2018, and 2020 dropped a lot for obvious reasons. It did grow a lot from 2018 to 2019. It did not drop too much in 2020. I expect their 2021 revenue to be a lot closer to 2019. And I rank their ratios 2 out of 10. The only ratios that are good are the price to sales and current ratio. The other ratios are really bad. The company does have negative equity. I used to think negative equity was a terrible thing because that's what everybody else told me. The more I think about it, negative equity isn't terrible as long as the company can service its debt. When I say service a debt, I mean pay the interest payments. If this company really wanted to, they can have positive equity, they can issue a lot more stock, and they could have positive equity. But as long as they're generating good free cash flows and good revenue, everything is fine. 2020 was a strange year, so you can't look at that as your benchmark, but they did fine in 2018 and 2019. For a long-term basis, I don't think you could go wrong with a company like this. It's going to be around for a long time. It's such a giant. It has such a strong market share of the coffee community. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on a link in the description below. Thanks for watching.